Love it. Are you gonna play the video?
Oh, no, let's just get into it. Hold on. So, welcome everybody. We are live for Ask Me Anything. It's just Shauna, Brian Fouts, and Gabe today. We do have some questions already in the chat. Actually, let me see if I can play this video real quick, and then we'll be right back. Actually, you know what? I don't even know where it is.
Yeah, Steven knows where it's at.
So never mind, no video.
Well, we can either jump to the question. Do you want to do any? Well, there's not much of an introduction today, is there?
No, and then let's see. We've got 6 viewers so far, so maybe we'll wait for a minute until we get a couple more eyes on here.
Yeah, for sure. So, Gabe, you're obviously you're in your normal location as always.
Yep.
Well, cool.
Getting ready for jiu-jitsu.
I'm in Northern Idaho this week, so.
Northern Idaho.
Yeah, Northern Idaho, out in the country. Yep. So I'm actually moving here so it's going to be an interesting next couple months.
That's amazing. Moving just before winter is always like fun. You got to race the elements and get in.
Yeah, especially here, we'll be doing some concrete work and stuff on the property. So it's a big race right now. So for sure.
And then yes, Tess, it's the trifecta right now. Gabe and I have to hop off at around 5:05 Eastern, and Brian might do a couple bonus questions on his own. But we can get started with the first question that we have. We got 3 questions from Navigate Your Ventures, who's been with us for several weeks now. So early question, how do I insure my car when I use IBC to pay for my car? Do I draft up a contract from my policy to myself and pay it on a schedule? What does the insurance company need from me?
So the question is, are you trying to insure your car like you're the insurance company for the car, or are you trying to pay your premiums from the insurance policy for the car? Because every state has their laws when it comes to self-insuring, but what a lot of people do is that instead of doing that, what we do is we reduce the deductions on the insurance policy for the car with your like State Farm, whomever it is, and you take that money and you put it into your policy, so it's working inside there. So that's really what a lot of us do, because to go into the whole self-insurance thing, that's a whole nother conversation that I don't know all the details of it. It's not easy to do from my experience, from my research. But so we talked about it here a couple weeks ago, I think. But if you want to reduce the deductibles and have your insurance company cover the deductible, that's one option right there to get more money into your policy, which also reduces your premiums on your car insurance policy. So that's one thing that I've done that before. But the challenge is that during the first, call it 6 months or a year, depending on how you're funding your policy, you're kind of at risk because you won't have your policy built up just yet. And so if something does happen to the car during that first 6, 12, 18 months, you might not have enough inside your policy to compensate for that deductible that's not in the car insurance anymore. Hopefully that made sense. There's a little more detail there.
I have a couple more questions, because the more I read this, I think about it a little bit. So when I think about what does the insurance company need from me? Like when I'm going to get car insurance, I'm just thinking about the year, make, and model, right? And then the car insurance company is going to tell me how much it costs to insure that. But then I think about, let's say you get in an accident and then you have a traditional lien on your car from some other bank or something. The insurance company kind of pays off that, hopefully, and then an excess of it. So would she, we lost Brian, but you know what I mean? Would she need, or Navigate Your Ventures, I'm sorry, I don't know. But like a contract stating how much is quote unquote on the lien, or what's against the car, maybe for in the event of an accident and actually having to use car insurance.
Yeah, I think it's between the lien, because sometimes they offer gap insurance to cover if it's above that, but there's always adjusters that come into play. They'll tell you what the market worth is for the car.
So I forgot I wasn't logged in yet, so I had to log in.
Oh, that's okay. But I was saying, when you get in a car accident and then the insurance company would pay off your lien if it was with so-and-so, maybe they're asking if they should have some sort of quote unquote lien on the car, but it's like a self lien.
So the other way you can potentially do it, I haven't done the research on this one just yet, but is that if you have a car that's worth $20,000 and you have a cash value worth $20,000, then that could compensate and be the backing for the insurance or for the car. Now the thing about that though, here's the thing you got to keep in mind. This is why we typically don't recommend doing that, or I don't. Is that if you do that, then you can't leverage that $20,000 for anything else, because it has to be free and clear for the car. So there's like you can actually have a bond. I think it's a bond. I can't remember how it works, but you can actually, if you can carry a certain thing in your car. I think Bill Gates at one point did this, and you can have that certificate in your car that says, "Hey, I have this coverage, so I have full insurance because I have this bond tied to the car." But you can't leverage it. So if you have cash value life insurance, you can't use the cash value for anything else. It has to sit there to be that backup in case something happens to the car. So, yeah.
Yeah, Brent's popping in just saying you're only taking a loan from your policy to buy the car, and then you just pay your insurance as normal, which again, I think they just say year, make, and model, this is how much it costs to insure this thing, then take into your driving history and whatever, and then you get paid if there is a claim.
That's the simplest way to do it, and if you go through the math. But once again, if someone's done the research on this, let us know, because I haven't done it to that degree.
Interesting question, though. Definitely got me thinking.
Yeah, self-insurance is what you're kind of talking about.
Okay, so different subject from Navigate Your Ventures is saying, do any of you use a holding company within your trust to use your multiple streams of income? If so, how, and how is this beneficial for taxes? I know you are not tax people. May suggest bringing this question back next week, possibly. Go ahead.
So here's my take on that one. So if you have a holding company, so if people don't know what a holding company is, it's how you have like one LLC up here, and then you have multiple LLCs underneath that one, or multiple assets under that one holding company. And I've done this before with multiple times. Now, you got to understand the difference between a trust and an entity or LLC. A trust is for probate protection. It's for privacy purposes, typically. The LLCs are for the protection, asset protection. So two different kinds of things. So when I've done this before, if you have multiple streams of income, yes, I want to have them held underneath separate entities to separate them in case one of them has something happen. You have a rental property, somebody sues that. You don't want them going after your primary home, going after your policy, by the way, going after your other streams of income. So for me personally, yes, I want to have multiple streams of income underneath separate holding entities or companies. And your trust can be the owner of those entities, by the way. So that's one way to do it. And is it beneficial for taxes? No, not really, because you're going to have the same deduction underneath, LLC number one and LLC number two. It's not really a beneficial tax thing to have them separated, in my opinion. From my own personal experience, yours might differ, and this is not tax advice, as you said right there. But yeah, that's kind of my take on it. I don't know, Gabe, if you have any different experience on that.
Yeah, I got into trying to learn all this, and I even try to go with Brent's guy who sets up his trust, and he was pretty direct with me and told me I don't make enough money yet. Told me I don't make enough money, so he told me I need to go focus on making more money. So I'm still at that level of building it up. But one thing I can say is, if you have a business that makes positive income, and you start a new business, and in the beginning it's making negative income, those can offset. So sometimes it makes sense to have like you stagger your businesses. You spend like 1 or 2 years building one, then getting another one, and you can start to stagger your money, because for now I just get the K1s, I get the distributions, and then if I have negative income, like my jiu-jitsu school was negative in the first 2 years, and that offset my income from the painting business. So it's not great for trying to qualify and buy a house, but
no, it's not at all.
it does minimize my tax liability. So it's thinking years ahead and just planning. The structures can be good, but just having an idea of if you're going to build businesses, if you're going to acquire assets. You mentioned multiple streams because I guess you're trying to figure that out. I was into real estate, and I wanted to build a big portfolio of rental income to have just passive income and be able to do jujitsu all the time. But it does take your attention and your care. Each of those assets is not literally a breathing thing, but it's an organism. It's an organization, and they can decay, they can fall apart if you don't pay attention to it. So I decided to kind of trade all that in for a jiu-jitsu school. So now instead of collecting doors, I have to build up students and collect clients. So as that grows now with maybe 100, 150, I might have the equivalent of, say $100 a door, it'd be say about the same, $100 of profit per month per member or so. But it's just about fitting it in with I guess your lifestyle.
Yeah.
I like that.
Okay.
Bring that question back next week when we have like a more of a group too, because I do think talking about like a holding company when you do have multiple streams of income is pretty interesting as well, even if you weren't factoring in the trust section.
And also, it depends on how the trust is set up too. Keep that in mind because there's different ways to set up trusts. So that's why, for me, I can answer to a degree, but I don't go set up my own trust. I don't set up my entities, my LLCs either. I have somebody else do that. That's their lane. That's their focus. But it's good that you're thinking about it because you don't want to go to somebody, have them do something for you when you have no even concept of what they're doing. You want to have a general idea of what they're doing so that you can say, hey, whoa, stop for a second or slow down, or hey, it doesn't seem right. And the last thing I'll mention in this one, a lot of people ask about, oh yeah, I want to set up an entity. I want to set up an entity. But to Gabe's point, and to Sana's point, don't get ahead of yourselves. You don't always need an entity. You don't need an entity to actually benefit from tax deductions either. By the way, that's kind of a thing that people think you have to have as an entity to have tax deductions. You do not. You can take business deductions on your personal tax return. So keep that in mind. So by the way, before, what was it, 1978, LLCs didn't exist.
That's crazy.
So people would just run their businesses in their personal name, which, by the way, opens you up for litigation. But that's why the LLC was created, was to actually protect you personally. That's the reason why it exists now. So
very interesting. All right, last question from Navigate Your Ventures. If I do a minor's policy with One America, then how much more can I put in each year for PUA in general? I'm assuming it depends, but what would be a good rule of thumb?
Well, I've done 2 of those. I did 2 of those today.
Mm-hmm.
Did 2 minor policies with that one. I think they were a 60-40 structured policy. I don't think I could go above that. So with minor policies, you're not going to be able to max. You can't do like 90-10s or 80-20s in most cases. It just doesn't work because they have so much long life ahead of them. So the one I did was a 60-40 structured policy. So it was and you could do that though with One America. You can put in the PUAs on that one for almost like I did it for 50 years on that one. So you can do them for a long time. Some companies are like 15 or 20 years. So I like One America for juvenile policies.
Amazing.
I just got one for my son. My dad set it up, or my dad bought it for him as a gift.
Nice.
But I got it. Craig helped me structure, but we did. Oh no, I'm sorry. I did this one. He helped me do one for me. But I did 50-50 and we did a dump in.
Yeah, I was going to say dump in you can do with One America.
Yeah, we did a dump in. We actually had to reduce it a little bit because I didn't have enough death benefit. But with this new policy, I'll be able to get him another one in about a year or so. Because they do look at how much you have as a parent. Because he wants to get one on my nephew, but my brother actually doesn't have any insurance yet. So he's got to be the first one to get a policy, and then you can insure the minor.
Mm-hmm.
Yeah, I've done those before, by the way, where the parent doesn't have the income to really get a IBC policy. Got a very cheap term policy in order for the grandparent to get a policy on the grandchild. So lots of ways to slice and dice that one.
Amazing. J10 is saying, if I'm currently doing velocity banking using my HELOC and have a large balance on the HELOC, should I start IBC using some of the available funds in the HELOC? Cash flow currently going into the HELOC to pay down existing debt.
That's a good question right there. It's as always, the honest answer is it depends. Depends on what you're going to use the IBC policy for as well. What are you going to be using it for? Because even if you have velocity banking, you're doing that through your HELOC, and you have an infinite banking policy, you don't change the cash flow. It still goes into velocity banking, your HELOC first, then it goes into the policy. You're talking about taking a dump in from the HELOC into your IBC policy, which you can do, but just it has to make sense from a cash flow perspective. You don't want to overcommit and then be strapped for cash, as I say. But yeah, we can run those numbers and we can use the debt blaster and run it as well and see how it would work and see if it makes sense. But I mean, I've done it before with clients. So yes, we have done that with clients before. Depends on what you mean by large balance as well. And I would do infinite banking in that scenario if it accelerated everything else and made everything else even better down the road. That's when I would do it. If it makes it more challenging, then I wouldn't do it.
All right. Alex Grace C is saying, does whole life insurance require a health exam?
Gabe, you want to take that one?
Yes. Sometimes I think I just saw something with One America. They have a flexible underwriting up to $2 million. Do you want to speak more on that?
Yeah. So in most cases, the answer is yes. Now, some companies, if you're in your 20s, you might not have to do it. Depends on the size of the death benefit, depends on the size of the policy. But right now, as Gabe alluded to, it's called flex underwriting with One America. It is super fast. I've had someone who was 34 get approved in less than a week, no exam. They were 34 years old. But it has to do with the size of the premium, the size of the policy. If it's very large, yes, you're going to have an exam. But also, I've had some people that are in the military, that are like in their 20s and 30s in the military, and because of that, they don't require an exam because the military is constantly doing the exams, and that maybe they have access to the records. I don't know, but yeah. So it just depends on the age of the person. And then for juvenile policies, no exam is required. So the parent has to sign an affidavit, of course, saying that there's no medical issues. So.
Kamau Blunt is saying, if I'm in my 40s and I have kids, why wouldn't it make more sense for me to get all my policies on my kids instead of me? Wouldn't it be cheaper to do it through them?
That's a great question, by the way.
Yeah.
Great question. So, I mean, obviously, Gabe, you just got one. So talk to that one too.
Yeah. In the ideal world, your parents would be the ones putting the policies on your kids. You should already have policies on yourself from your grandparents. That's how they teach it as the family banking system. I don't know if you guys have heard of Jason Lowe, but he does some wonderful seminars on this idea. That's something I want to eventually have for my family. The idea with the life insurance company, in the end, it's about protecting their income. Like if you pass away and you don't have insurance on yourself, then the kids won't get any money, right? So there has to be a level of protection there. You could, I guess, do it with the kids, but it makes more sense the way I've learned. You start with the older generation and then you trickle it down. But what are your thoughts on that?
So I call this the waterfall effect.
Yeah.
So you start at the very top of the food chain when it comes to the family, and the top of the food chain is normally where the money's coming from. More money here, then you come down. Like if you're like an adult, you have certain income. Your adult kids are going to have less income than you because maybe they just got out of college, and then your juvenile kids are going to have no income. So you insure the income first. This is talking from the insurance perspective, not the infinite banking perspective, by the way. You insure income cash flow first, because if something happens to that cash flow, everybody below that is going to be impacted financially. So you want to make sure they're taken care of. Then you can layer the policies as you go down the family chain. That's why. And the insurance company, that's the way they think about it too. So they won't let you insure like a child if the parent is the one making the income, because if something happens to the parent, then the child is SOL, right? Because there's no income to support them. So you start with the parent first, then the child, and that makes sense when you think about it. Now, to answer the question from an infinite banking perspective, you cannot get the same policies you can on adult on a child. They're not the same structure because you're limited on the gross income or the age of the person. So a child, you can't put $100,000 into the policy. You can't do that because it doesn't make sense because they don't have any cash flow or income. So that's the limiting factor there. So you can get more on you, and you can structure them to have a lot more cash value. The reason why you can get more cash value on an adult is because you have less time to live than a child, which is kind of weird. So on a child, they're going to have a lot of life ahead of them. So the compounding interest inside the policies is going to be very good throughout their entire life. So you have to structure it so the policy doesn't mech, bottom line, modified endowment contract. But we walk you through that and stuff when we're talking with you. But the last thing, wouldn't it always be cheaper? Yes, it is. You can do child policies that are $100 a month, and I did that for someone today. And later on this conversation, if you want, I can explain to you why that's so powerful on a juvenile. But yeah, I've done some pretty cool things. I did a presentation a couple of months ago on juvenile policies. It is staggering how a little bit of money can turn into an insane amount of money down the road for them. And that's what Gabe's talking about. You look at the generational aspect of this, and you start when you're young. I mean, yeah, the policies they're hard to fathom how good they are.
For example, so when my son turns my age, 35, his base premium will be $3,000. That year, his cash value growth is $17,000. So it's 475%. So he'll thank me that my dad and I helped him start this thing when he was born, right? Because it's going to be so efficient. So if I wanted to put more money, or my dad or whoever, if we wanted to put more money into my son's policies, we couldn't, because I'm at my maximum for my death benefit. So I have to get more on myself, and that raises the bar. So now I can start putting more on my son. So I want to be able to put as much as I can while he's still young, so that once he gets to 18, maybe I can give him 5 to 10 policies. That's a
Yeah.
challenge for myself to kind of grow it. But I think your example, Brian, is perfect. The waterfall.
Yeah.
Well, one thing we didn't mention, what you just sort of mentioned, Gabe, was how your son can only get so much based off your coverage, and usually it's 50% of what Gabe has on him. So if Gabe has $1 million death benefit, his son can get up to 500,000 death benefit. Usually is that rule of thumb.
Yeah, and every company's got a little bit different, but that's the other part. Good point to ring up, Shauna. That is, yeah, the insurance companies will limit the amount of death benefit you can have on a kid based upon your coverage. So if you have no coverage and you're insurable, then it's zero. By the way.
Yeah.
You have to have something first.
And then just the flip side. So kids policies are cheaper, and they'll grow to be crazy down in the future, but you don't necessarily have all that time that your child may have to build all that. So that's why we do the dump-ins. That's why we have bigger policies on ourselves, is because we can't, if we started $100 policies before we're actually using our bank for something, it would be several years. It would be a long time.
And
Cool.
I was also gonna say, maybe that's not even your money. Then it's your child's money, or their your grandkids' money. You still want to have money for retirement income. So maybe it's another reason to maybe build yours. But I was starting to think that, because once we give this policy to my son when he's 18, it's for him to now use and either build a business or go to college, whatever he wants to do. It's not gonna be my money or my dad's money, right?
Oh, sorry, that was the one we just did. Okay, so Mark White is saying, I had 240,000 in my policy. I took a loan for 220,000. Is that going to hurt me until I get it back in? I plan on putting it back within 2 years.
Hurt you in what way? So, I mean, in my opinion, it won't hurt you. No, it's just you got to understand the interest and how it's charged and how that affects the numbers. I don't know if the loan is going to generate cash flow for you, but bottom line, it won't affect the dividends or the growth or the performance of your policy. It won't affect that. So it depends on what you're asking specifically around how's it going to hurt you. But like as an example, this is some of the ways that it doesn't impact your policy. If something does happen to you, that proverbial bus comes around the corner and hits you, then the death benefit would be paid out less that 220 loan. So it'll reduce the death benefit if it has to be paid out, but it won't affect the dividends. So just kind of keep that in mind. But yeah,
and it doesn't affect the growth. Like you having $240,000 in your policy and you having 220,000 out doesn't affect the policy at all as far as the way it compounds and what it's there for.
Yep. And Gabe, you're taking loans out for your business all the time, and it doesn't impact your policies at all, right?
Yep. Well, but that's the other thing. I was gonna ask how he's using the money, because if he used it to pay off debt, it's only helping you because now you don't have that money going to that third party creditor. Now you're gonna eventually pay yourself back, right? If you use the money correctly, it should only be helping you by you taking out the loans.
Yeah.
As you learn to use your bank, it only helps you to take out loans. But I don't
Yeah.
want to get in trouble with.
Yeah. Well, and
Yeah.
the way what you just said about there being 240,000 in your policy, you borrowing 220, and we're telling you it's not hurting you mostly in any way. That's kind of the benefit and one of the great things about infinite banking too,
Yeah.
and why
Of
people
course,
do this.
and of course, we're talking about in the policy. What you do
Yeah.
with the cash outside of the policy is a separate, thing.
Yeah.
So hopefully not going to Vegas and putting on red.
Correct. Okay. So I know me and Gabe got about 7 more minutes here with you guys, and we have a few more questions, and this has been going great so far. I see a lot of good
And I'm like,
feedback on today. Edward is saying, so how would I set up one of my policies for my business partner, and would they be the one to pay for the premiums?
kind of up to you, Ashley. It's really up to you how you want to set that one up. So one of the ways to do that is if key employee insurance is kind of what that is, so that if something happens to one of the partners, the other one has the capital to keep the business going or replace that person. But usually, if you have a business partner, the business would pay the premiums. Like that's usually how I would recommend setting it up. Because if it's for business purposes, have the business pay for it. That's what Gabe is doing. You have business policies, or for business. You loan to your business, correct? Did your business pay for yours, Gabe?
No, mine are in my personal name, and I just loan to myself. But we're trying to figure that out for our painting company because my dad is the primary owner. I own 10%. My brother owns another percentage. So we're trying to figure that out as well. But set up a call with one of our money mentors.
Yeah.
I'm sure they'll be happy to help you. And everyone has a different situation. We do use almost like a Swiss Army knife, the whole life policy, but it's we're gonna engineer it to fit your needs. And if it doesn't work with one company, we have multiple companies we work with. So just set up a call and we'll be able to help you. But yeah, it can be done.
Yeah, and you can own the policy on your partner. They can own the policy, and you're the beneficiary. There's lots of different ways to set up. It just needs to be set up the way that makes the most sense for your situation.
Perfect. And then for anybody, I just put mentors.beyourownbanker.com is how you can book a call with our team. Okay. Edward's also saying, is there a referral program? I try to get a lot of my military friends to do this.
Just schedule a call with us. We can walk you through what that looks like. I mean, we don't, because life insurance is it's licensed, so it's regulated too. We can't. There are some things we can potentially do, but in most cases, it's a challenge, to be honest. But just schedule a call with us. We can talk through that.
Perfect. And then one last question is Jason Lau. He is actually up in Canada, and he does like a form of infinite banking up in Canada. I'm assuming it's called this infinite banking up there as well. It's just their insurance companies are a little bit different than ours. But he does a lot of the same stage speaking and a lot of trainings and stuff like that as well.
The only difference really in Canada, I mean, all the different insurance companies, but it's the taxation. Taxation of the policies is different up there.
Okay. Derek is saying, any issues with 20-year-old and pregnant getting a policy?
Just based upon age and pregnancy, the answer is no.
Okay. Yeah, I think Drew's wife just got approved for a new policy while she was pregnant. So I do believe at least somebody I know has had that happen.
I've had clients that are pregnant.
Okay. And then I'm going to start. Okay, so Knights of Israel is saying, if you had 10,000 in cash benefit or cash value, we'll say, how much could you borrow and what would happen if you put the money you borrowed back in?
Depends on the company, by the way. So sometimes they operate a bit differently. So one company, if you have 10,000 in there, you can borrow 9,500. The reason why I say 500 is the interest rate's 5%. So they hold the annualized interest rate out of the loan, and then based on how you pay it back, they'll adjust the amount of interest charged. That's they charge the interest up front. Some insurance companies like Lafayette will charge the interest after the fact, so you can borrow pretty much almost up to the entire amount. So it just depends. But I always say 95% is what I recommend, just to keep a little bit of buffer inside there. And then once you pay it back, then you can borrow back again. So it just keep in mind the cash value doesn't change, but the amount you can borrow does. So if you pay it back, you can take it right back out again.
Mm-hmm. Yeah, and actually, well, I guess I don't know if all insurance carriers are the same, but I have I have two different carriers that I use. But Mass Mutual, it'll tell me like my cash value available, and I can scroll down the page a little bit more, and it tells me how much of a loan I can take out. And sometimes those numbers are a little different. Like Brian said, it's like 90% of the cash value I can take out in the loan. But your dashboard's a good place to look for that.
Mm-hmm.
And then Brian, I've got 1, 2, 3 starred right now, and we'll do this one, and then I will probably have to hop.
No worries. Yeah, I'll be here.
All right. So Brian's saying this may be a one-on-one conversation, but we are 68 years old, have 3 adult children, and a first lien HELOC. I guess it got cut off, but Brian, yeah, you can absolutely. That's what their phone calls are for. Just to talk about your situation and what you can be doing with your bank and how it all makes sense.
Yeah, I've set up policies on people that are 68, 69. But it depends on what you're trying to do. It might make more sense to set them up on the adult kids based upon your goals, by the way. So that just depends on your situation.
Yep. And then again, you can go to mentors.beyourownbanker.com. It'll open up the calendar to our team. And then with that, Brian, there's 3 questions, and I'm going to jump now, okay?
That's good.
Okay. Bye, everyone.
Bye.
See you guys.
I can hang out for a little bit more.
Sure.
There's no one here yet.
Yeah. Hey, David. So what is the minimum amount of money to get started with a policy? I do understand you want to put as much as possible, but just curious the amount to get started. Thank you. So, Gabe, you want to take that one until you have someone in there?
Sure. What we usually say is you take your age. So I'm 35. You multiply that by 10. So that would be $350 for the monthly minimum. Does that sound about right?
Yeah, it's a minimum that we recommend. It's not required, but it's a minimum recommended to start a policy. And then the maximum is going to be dependent upon you as an individual. So gross income, liquid net worth, those set the maximum. And every insurance company is slightly different, but pretty simple. If you make $100,000, 20 to 25% of that can be considered by the insurance company towards premium deposits on an annualized basis. If you make, $50,000, it can be anywhere from 15 to 25%. If you make over 150 or more, it can be 25 to 30%. And that's based upon gross income. But we calculate that out for you. And if you have liquid capital, that can be considered as well. So, but yeah, minimum 10 times your age per month is a good place to start. Let's see here. All right. Camel said, if I have a friend who is down on their luck, can I set up a policy for them and pay it to help them get back on their feet, even if I don't conduct any business with them? So good question. It's going to depend on the situation, but if you're going to get coverage on them, the policy is going to be based on them. So if they don't have a lot of income or don't have any income, it's going to be hard for them to qualify, because at the end of the day, the vehicle that makes infinite banking possible is a specially designed whole life policy, and you have to qualify for that. And insurance is about replacement value of income or future value. If they don't have any current future value, it's hard to get them insured. And also it's like, what are they going to use the policy for to get back on their feet? Second thing is, if you're going to be the owner on a policy on somebody else, and like, let's say you fund it as an example, you have to have an insurable interest on that person to do that. Okay. Even if you own it and you're paying for it, they still have to qualify financially. Make sense? So so that is a challenge sometimes. And it comes up quite a bit where someone says, I want to get it on so-and-so. I want to help them out, get them his policy, but they don't have any income. It's very hard to qualify them for a policy, because the insurance company is like, well, what are we insuring? Right? If there's no cash flow or income, it's hard to insure that. Let's see here. Knight of Israel says, thanks. Can you use the borrowed money to increase the cash flow?
All right, I'll let you get that one. I gotta get off.
Okay, see you, man.
See ya.
So Yeah, I mean, that's one of the main things that we do with infinite banking is we borrow the cash value from the policies and put it into cash flowing assets, right? Now, can you use the borrowed money to increase the cash value? No, not really, not necessarily, because the policy cash value is going to grow based upon how you're funding the policy. Premium deposits, the dividends, those are what increase the cash value. If you borrow money from the policy and put it into an asset over here, that's outside of the policy. That can create more cash flow in your life, but it doesn't necessarily go back into the cash value per se. The cash value is pretty structured on how it grows. But hopefully that makes sense. If not, and you always reach out to me and I can help understand that a bit more. All right, let me look at the other questions we got in here. Okay, let's talk about this one. IUL is good. I don't know if that's a question or not. We don't do IULs. We don't touch IULs. They are not part of infinite banking as far as we are concerned. They are a very different vehicle. We have a lot of videos on that. We can get in. You can go watch. But yeah, as far as the Nelson Nash Institute that certifies us as infinite banking practitioners are concerned, you cannot touch IULs. They are not infinite banking. And in my personal opinion, if you have an IUL, I'd be concerned about the next few years because when the markets go down, the performance is going to change. So the short answer is no, we don't do those. Do you have to make a lot of money to do a policy? Absolutely not. No, you do not. I have people that are, $30,000, $50,000 of income doing policies all day long. I just say this, Brian, and nice name, by the way, just start with where you're at. Just start with where you're at right now. And then as you scale up and as you make more money, you can do more policies. So you create a policy that is based upon where you're at today. But if that changes and you're having more income or more cash flow in your life, just do a second policy because you can do multiple on the same person. So as your income goes up, so does your insurability, which means more policies. So hopefully that makes sense to you right there. Brian says close to 50 would be like $1K a month. That's pretty much the middle of the road for what most of my policies are that I build for people. $1,000 a month is very common. So, and your age is not going to be an issue in that scenario either. So, yeah. So now, once again, you don't have to do both of you. You can do one and then the other. Now, when you do the math on that, $1,000 a month, you just got to kind of back into that. Do you qualify from that? And if I did the math right now, do a 12,000 divided by 0.25. I mean, if you made $50,000, you could, well, not 50,000, but yeah, you could qualify for that at 50,000 right there. So yeah, just gotta keep that in mind. Yeah, if she makes about 75. Okay, there you go. I see you guys more comments coming in there. Times 0.25. I mean, that math right there is 18,750 per year. So annual or annualized. So monthly, that's more than 1,000. So it shouldn't be an issue there. And if you have 30K, I'm not sure that's cash flow, Brian, but yeah, I wouldn't see that being an issue. And another question people sometimes will ask is, well, what if my spouse doesn't make any money, but I do? You can still both get insured. We just got to look at insuring the main income earner first, and then the other spouse second. Okay, a good question right there. So you're semi-retired, 30K in investments. Yep, that makes sense. What's up, Drew from Canada? So Mike, can I do this for my cousins? Yes, but you have to show insurable interest. And what that means is if something happens to them, like they get hit by that proverbial bus, they graduate to that place up in the sky, does that financially impact you? So cousins are kind of getting a bit removed. So like brothers, sisters, spouses, kids, parents, all those, if something happens to them, there can be a financial impact to you. Now with a cousin, maybe not. Now if you're very close, if you're doing business together, if they live with you or you live in the same home, something like that, then yeah. But it just depends on what the insurable interest is that you can point to and say, this is why I want to do that. Now, there are some other things you can do. So if they want to do this with you or vice versa, or if you want to fund a policy on them, they can go through the application process. They can get insured. They can be the owner of the policy and the insured to start with. And then at some point down the road, if it makes sense, 3 months down the road, 6 months, they can always transfer ownership to you. And now you own the policy on them. And then you're the one in charge of it. You're going to be the one that funds it, that borrows it, that manages the entire thing. So keep that in mind. You can always do that right there as well. Let's see here. Can you convert or exchange universal life or start a new policy? Yes, you can. So very, very common to do a 1035 exchange from a UL, VUL, IUL into a whole life, specially designed for infinite banking. I've done dozens and dozens and dozens and dozens of those. Yeah. Because what happens is someone starts a policy with an UL or VUL or IUL that's not infinite banking at all. It's just a high death benefit policy. 5 years down the road, they have some minor cash value, but they're not. It's not infinite banking. We'll roll that cash value over to a whole life policy, so there's no tax implications, and then off to the races with infinite banking. So yes, you can, or you can start a new policy. Depends, but we walk through the numbers on that to make sure that it makes sense, because you don't want to do a 1035 exchange if it doesn't make sense. If you have a policy that's very optimized, it might not make sense. Are there any options for getting insurance on your parents that are older than 70? Not very many, to be honest, because it just gets so expensive. It gets very, very expensive. I did a quote for someone yesterday, I think, and it just didn't make any sense. The issue is that if you put in a certain amount of money, are you going to ever have more cash value than what you put in? In most cases, the answer is no. Now, you do have a death benefit that is more than what you put in. But as far as infinite banking goes, it's just not very optimized at that age. It's why a lot of people who are 70 will do policies on somebody else. So if you're 75 or 70, you've got good cash flow, you've got money lying around, I want to put it to work, but I can't do a policy on me. They'll do it on adult kids. They'll do it on, siblings that are younger, things like that. But yeah, it is very challenging at the age, over to the age of 70, to be honest. How old is too old to start? So I've done them on individuals that are 69, 70, I think even maybe 71. And typically females it's a lot easier than males. So sorry, guys, this is the way it is. But yeah, because females live longer, they can get policies a little bit later on in life compared to a male. So I always say that, it's 68, 69 you can, but after that, it gets very challenging. And the numbers just, aren't as good. So. All right. Camelis asked, can you convert a term policy into a whole life policy? In some cases, yes. It's called a convertible term. In fact, I just had a client yesterday that we were looking at their policy and he didn't know, and I went and pointed it out. Yep, here's where it says convertible. If you look at your policy for your term, your contract, there'll be a section that's called convertibility or something like that, and it'll walk you through what it is. Now, does it make sense to do it? And why would you want to convert term into whole life? That's the question right there. So if you're insurable and you can get a policy, it doesn't make sense to convert the whole life. If you don't need the whole life, you just cancel it after you get the whole life one. Now, the reason why you would convert is if, let's say you've had a stroke or you've had skin cancer or something that could potentially impact your insurability, and you have a term policy that's already in place and it's convertible, you can convert the death benefit from the term policy into the death benefit on a whole life policy. The premiums will be different, of course, but you can do that. And sometimes you avoid the exam and having to go through that again. So that's why you would do the rollover or the conversion from term to whole life. But once again, it has to make sense. I just would not arbitrarily do that. And then, of course, additionally, if the term insurance policy is with company A, and you're going to do a whole life infinite banking with company B has to accept the convertible policy from company A. So if someone's going to do it, what we do first is we'll say, give us the policy, the term contract. We'll take it to company B and say, hey, will you accept this for a conversion? And they'll let us know. So that's how that works. So. All right, I think we may have gotten through all of the questions. Any other questions you guys got? This is the Brian show today, so. But I'm loving these questions, by the way. So yeah, any other questions, let me know. But until then, I'll share one thing that we were talking about before on this call, and that had to do with the juvenile policies and why would you do juvenile policies. And Gabe was talking about how his is pretty powerful. But I did a presentation with one of my mastermind groups that I run. And I'll explain to you why the juvenile ones are so important and why the wealthy do this. So let's say you have a child that's born day one, you get a policy. And let's just say if you do $250 a month on that child. Now, I don't remember how much cash value is there when they're like 18 and 21, but it's quite a bit, $50,000, $60,000, $70,000 of cash value. So what can they do? Well, college, their first car, pay for their wedding, right? Down payment on a home. Now, when it really gets pretty powerful is later on in life. So when that person turns 65 years old, they will have put into this policy, remember, $250 a month, they'll have put in about $119,000. Now, what's the cash value at age 65? They started day one. At age 65, the cash value is around $650,000. They put in 119. The cash value is $650,000. That's insane. The death benefit is I think it's $2 million, $1.3 million, right around that mark. So if something happens to that person, $119,000 turns into guaranteed tax-free $1.2 million. Now you understand why the wealthy do this on every person in their family when they're born. Now, let's even flip that on its head a bit more and do one more thing. Day one, $250 a month, and let's add in a $5,000 lump sum as well. We call that a dump in. It's a lump sum PUA or single PUA. So now at age 65, that person has put in $124,000 into their policy. What's the cash value now? It's about $1.3 million. So if you do the math on that, you add $5,000 up front, and all of a sudden you've added $650,000 more of cash value. Now, granted, it's 65 years down the road, and the death benefit is $2.4 million. That's just by adding $5,000. That is the power of uninterrupted compound interest, which is one of the most amazing things about infinite banking. So just kind of sharing with you some things that we were always thinking about, but someone says, well, why would I want to do this? That right there is why the wealthy do it, and why you've got to think about this generationally. And then the last thing I'll mention to this, and this is something that I was talking to a client about yesterday, and Tess at the Brian Show, is why don't more people do this? And why do the wealthy do it, and yet the average family doesn't? So what I just explained to you, the math right there, the challenging thing for a lot of people is that if you do that on your child, you're not going to be around to see the benefits, most likely. You're not going to be around to see that. The wealthy, why they do it, is because the generation before them did it. And the generation before them did it as well. So they're seeing the benefits in their own lives. So of course they're going to pass it on. But it had to start somewhere. Generational wealth has to start with somebody taking action for that next generation, knowing they might not see the benefits, but they know that next generation is. The wealthy have been wealthy for generations, right? The current generation sees the results in their lives. Of course, they're going to do the same thing for their kids because they know it's going to be the same results. So it's a mental thing, by the way, but yeah, it's kind of note that. All right, Night of Visual. Another question here. I'm 33 and I have 10K in savings of it, but I have 10K in savings but that all in a policy. How long will it take for me to be able to borrow it? Okay, so if you're 33 and you have 10K in savings and you want to put it into a policy, you'll be able to borrow against that a certain amount. It depends on how you fund it, but let's just say 90% if that was a dump in within 30 days. So it's called a HECV, high early cash value. You can borrow within 30 days. Not 3 years, by the way, not 2 years, 30 days. If someone tells you that, oh, yeah, you can do that, but it's going to be about 2 to 3 years before you can borrow money, run away. That's not infinite banking, by the way. So, yeah, but yeah, it's about 30 days. And I'm being conservative with that, so yeah. Pitt Tony C. New York City. Is that juvenile policy through Mass Mutual or Lafayette? That one, when I built that illustration, it was through One America. Yeah. And by the way, Mass Mutual has really amazing juvenile policies as well. I do them with Lafayette, but if I can, I always prefer to do them through One America. But as we were alluding to earlier in the call, there's limitations on how much you can do on the child based upon the parents' coverage. So sometimes we just have to go with Lafayette instead of One America because they have a lesser death benefit. But yeah, bottom line is that was One America. But they all have juvenile policy structures that you can do, but you just got to test them out. But yeah, I love One America for juvenile policies. They're great. So cool to answer that question. All right. Well, I'd banter with my my colleagues, but it's just me looking in the mirror right now. So if there's no other questions, we can call it a day. I have actually a client call here in about 9 minutes, so I'm going to hop on that here in just a second. But any other last minute questions? And by the way, I appreciate you all sticking around and great questions today as well. It was awesome. And Tess, I have to have Tess have you come on and talk on one of these as well and share your experience because you've got quite a bit. So by the way, Tess is one of our long-term clients and also one of our colleagues now too. And Sonia, I actually talked to Sonia here. Actually, was it today? I think it was today. Yeah. So that's awesome to see you there. Okay. So rephrase from earlier question from Navigate Your Ventures. If I put in at 12,000 a year for my juvenile, how much more can I put in after the first year? Depends on how you structure it, by the way. So you could do 12K in the first year. That could be a $10,000 dump in and a $2,000 premium deposit. And then after year one, you put in $2,000 per year as a deposit, for every year thereafter. So it depends on how you want to structure it. If you want to put in, 1,000, 3,000, etc., there's going to be some limitations on the dump in, but we can run the math for you on that. But yeah, I mean, it's just a ratio. But like 2,000 and then maybe a $10,000 dump in would be a pretty common structured policy. And thanks, Derek. I appreciate that, man. Thanks, Alex. Yeah, Tess. Yeah, it'd be great to have you come on these, and I know that you're getting into that side of it. So yeah, I got my practitioner's book, by the way, right behind me somewhere as well. So by the way, what we're talking about is if you go to the Nelson Nash Institute, they have programs where you can actually become a practitioner if you want, and they have a lot of great education. But Tess is going through that right now, which is awesome, and it's a great program. So, all right, everybody. Unless you got any last minute questions, I appreciate all you guys being here. Appreciate all the support and stuff, and we will see you next week on Ask Me Anything. So with that, everybody, take care. Have a great rest of your week. Stay safe. And if you need anything, let us know. Oh, and obviously, by the way, I will put the link here in the chat box if you guys want to schedule a call. Whoops. Nope, I can't find it right now. Where'd it go? I think I'm trying to put it in here above. There it is right there. So if you guys want to schedule a call, to go to mentors.beyourownbanker.com. That'll give you access to our team, one of our mentors like me that you can chat. And if you want to reach out to me, obviously you can do that as well. All right, take care. We'll talk to you soon.